If you're a first-time investor, one of the most important decisions that you're going to make is the pricing of the property that you buy. It is going to either accelerate your property investing journey and you're going to get years ahead, or you're going to go the opposite way and you're going to stagnate and fall 4, 5, 6 years behind what we want to actually do. So if you're a investor looking at what should you pay for your property, especially in Western Australia. So a lot of these figures I'm going to go through in here is for Western Australia. So whether you're in Western Australia, you're an interstate buyer, or whether you're an overseas buyer, we're going to go through the three categories that you probably don't even realize all properties fit into when purchasing or investing. So what most investors get it wrong is what price range should your first investment be? And it is the most important decision that you'll make in, I would say, the first 5 years of your investing. The first one should propel you incredibly fast, like a slingshot. It should be shooting you straight up into an upward trajectory. And what you should find is it will take you up like this, right? So the first property will be here, second here, and as we can see, we're sort of going up. So if we draw an axis, this will be properties, and then this will be time. And as we're going through, you can see property 1, property 2, property 3, property 4, and it's just getting shorter and shorter in time. So we need to make sure that pricing decision is right. And the most common mistake we see first investors, home buyers, mainly investors, is they always ask, what suburb should I buy in? They're looking and they're so fixated on a single suburb, and they're just saying, what I really want to go in here because of work, because of this or that, any other lifestyle factor, and they just try to make it work with that suburb because they think it's good. What they should be asking is what price range actually makes sense. So they should look at their financial goals, and you should say, okay, I know this suburb is better, right? So if we have suburb 1, well, that's big on, and suburb 2, and we know suburb 2 puts us on a trajectory like this, and suburb 1 sort of puts us here. But on the condition is that maybe suburb 1 just has a higher reputation. Maybe it has, it's a little bit more expensive, or it's just a little nicer. Now it just doesn't make sense financially, right? Because what we're going to do is, maybe if we pay $1,000, get rid of this, maybe we pay $1,000 a week here and per week here for the nicer one, but then maybe it leaves us $100 per week, like a leftover, right? That's option 1. And then maybe in option 2, we'll draw it over here, it is $600 a week and we have $500 left over. Now we take this over a whole year and we take it in a long enough time frame. So we do this over here, we're saving, this is a 25k saving right here, right? Or this, the extra money that we'll have. This, we're looking at what, 5k? I should have done it in red, 5k. So a huge factor with investing is people always are going down this path. They're saying, yeah, but it's just a little bit more, it's just a better reputation, or there's just something, there's something about this that they do it, and they'll choose it rather than saying, what price range makes sense for me? If you're doing this, this is a fall behind, right? You're falling behind 4 times more than the other person. 25k, we do this over 2 years, we have a property. So 2 years equals 1 house. And we're looking at this, we're growing 4 to 5 years. That's 5 to 6 years. We'll say 5 to 6 years, accounting for inflation. And these are the questions that should be asked. So let's clear this. Why the pricing matters. 1, cash flow. The rental income versus holding costs, liquidity, equity in it. We need to make sure, are we paying $1,000 mortgage and then maybe it's only like, I don't know, $100 shortfall, $50 shortfall. where with the interest rates that they are now at about the 5.5%, people are often opting to just lose $200-300 a week for a certain preference in a suburb, and then they're just saying, oh yeah, that's okay because negative gearing. You don't want that, right? We want cash flow in the simplest sense. That's a story for another time. Just the negative gearing stuff. But cash flow is a huge part, especially when it comes to serviceability, which will be your next issue that you'll have. So how much equity are we borrowing and our borrowing capacity for property number 2? We want to make sure, because we want to make sure that when we're buying the next one, the rental income for the next property can actually allow us to buy the second and then the third and then the fourth, because we need to keep in mind that only 80%, some banks are a little bit more, but 80% is calculated into serviceability. So if you make $100 a week, the banks are only calculating $80 per week. So if we don't have a large enough cash flow or a buffer, this will really start hurting serviceability. There is ways around it before all my accountants arc up about it. But just from an overall bird's eye view, we also have risk level. Financial exposure, security, shifts in the markets, supply and demand, the infrastructure, the public housing going into the suburb. There's a whole lot of stuff that can impact the risk. And then we also have future growth. So infrastructure, like we said, we have more people. Is it a growing suburb? Is there work or facilities coming around it? So the newer land, for example, that is north, south of the river, are we building places for people to work? So there are 3 distinct price ranges, and each bracket comes with different opportunities, risk, outcomes, everything like that. Now, under 550, and I know a lot of people are going to say it's impossible to get a house for 550, but I'm going to put 550 as a entry level option. The reason being is the difference between the equity that you can take out of the house is obviously a lot bigger. So we'll get through that on the next slide. But you also have the shortfall or the negative gearing on certain properties that may come into effect, or just the cost of it is a lot higher. And when we want the first house, we want to make sure that we've got that slingshot going up. Second one is about 600 to 800, and then 900 plus for premium properties. Now, understanding it obviously helps you make a better choice. And you'll look at these 3 and say, yeah, I'm up here, or maybe it's my first house. Maybe we don't have a huge pool of equity, or we don't earn enough in our full-time jobs, or perhaps self-employed, or we just can't do that. So we should be going in bracket 1, for example. So 600, under 600K is usually one of the best entry points. Now, this is excluding if we have money buyers or financiers where we can use like blocks of units and stuff. But for 90% of the population, under 600-ish is a good starting point. And yes, there is houses you can get under 600 in the eastern states. So when we go Sydney and Melbourne, obviously you just need to go further out into the outskirts to find these types of houses. In Western Australia, we can see there is not a lot in terms of houses. However, when we change a filter, actually before we change filter, you can see a lot of them there is a lot more in the sort of up and coming suburbs. So you'll find a bit in Rockingham. We'll find more as we go down in here, and so on. But when we change this to apartments, right, or townhouses, there is a lot more. Now, I'm not super fond of apartments and townhouses. However, they can work in certain situations. Depending on the strata, how much you pay for strata determines a huge factor in this. My first house was a strata build. I brought it pretty much the first owner that as soon as they built it. In 2 years, it made 100K of equity, and it was also running at a positive geared of $120 per week. And that I brought that for $420,000. So I sold it for just over $500. So it does work It's just the numbers just have to really make sense, and it may just take a little bit longer to actually find those. But apartments are going on the rise. Keep that in mind. With houses costing so much, it puts people out of that market, and then they need to go into the next market, which is the apartments, townhouses, and all that. And we're looking at about a 20% increase in these assets for 2026. And obviously, the upside is it's a lot cheaper. It usually delivers higher rental yields because the mortgage repayments are not so high. And the bad is obviously it's not super ideal. We have certain fees. If we're going to the unit stuff, we're looking at strata fees, body corporate fees. And usually it's a slower capital growth, but you can still get houses under 600,000. The best way to get them is through a buyer's agent, exactly what we do, right? So if you are trying to find a house under that price point, then my link is below for a calendar call, and we can jump on a call and we can discuss the needs and the fit and get you into these houses that are a lot cheaper. Usually these are done through off market. So if you're not going to do it through a buyer's agent route, then you can just find a house you like, go down a few streets and just go door knocking. Yeah, owners are usually happy to eliminate the whole real estate aspect of having a sales agent or a buyer's agents aren't as hated as sales agents, but it eliminates. So there is ways to get them. Now 600, 800 is usually the balance. So that's where majority of the market sits. There's a strong rental demand. It appeals to families, professionals. These types of houses are just homes essentially for families growing up. They're usually close to schools. They are close to transport amenities, bus stops, train stations. A lot of these suburbs as well are for owner occupied. So properties that buyers actually would live in themselves. And as you can see, for resale in the future, if we're going to actually start selling off some of the properties to take the equity out, they become a lot easier to sell. And they also just have a lot of solid fundamentals. So a lot of balanced growth, like your sort of capital appreciation. So we can, as we showed you in the graph like that, rather than just something like this. Now, we got to turn this one off. Over 900 is the premium properties. If you're a first home buyer, if you're a first investor, there is advantages. There's big advantages. There's also very, very big trade-offs. The advantages, obviously, it's new build, it's modern, it looks nice, it's going to last a lot longer. These are usually in suburbs that are very strong infrastructure, which is why they're priced that way. So we're looking at local landmarks, we're looking at tourist attractions, we're looking at just closer to work. CBD is a very good example of this. And they're called blue chip suburbs because it's just, we'll just say it's where the fancy people live, is just the easiest way to think of it. There's also stronger long-term growth. So these areas tend to outperform over decades. Keep in mind, decades, that is a very key word in the portfolio, as opposed to a short-term, multiple, quick, renovate, fix-ups. They can outperform in the short term. Granted, they are shorter sales cycles and you do more of them. We also have tenant stability because they're obviously going to want to stay in there a lot longer. Now, the trade-offs are the loans are massive. So you need a big deposit. You need B, you're going to have a bigger shortfall, negative gearing for a lot of them. And your holding costs, so interest payments, ongoing expenses, maintenance, all that stuff does cost a lot more. And there's also a lot less margin for error. If you buy a house and it's $1 million, if the market goes down, then it's going to be hard to sell the $1 million. So between about we'll say around 2013 to 2018, we'll say before COVID, when things were normal, when houses were over $1 million, they were hard to sell. There wasn't a lot of people that had that sort of cash, and especially after COVID or during COVID, that just all stopped. So there was a big delay in it. Now it's not too bad because these houses have gone up. People understand, and we're hitting into a buyer's market. But at that time, that took 6, 7 years to actually sell those houses. And I know it because we had clients that were trying to sell over $1 million houses that just couldn't do it. And then the ones that were selling were doing price drops of two, three, $400,000 just to try to get it over the line. So these premium blue chip, they have a lot less margin of error. You need to make sure that the numbers are right with these, and obviously slower portfolio growth. So you can, if you're into stocks and bonds, these would be essentially bonds at the growth rate, and the smaller ones are the stocks, or that'd be crypto with how volatile that can get. So what's the real goal of your investment? We've gone through the three categories, but you need to now look at them and say, where am I in my journey? What can I afford? What's the best play for long-term growth? Because if you're buying an investment property, you're probably not going to stop at one. Like, let's be real, you're probably going to want to 5, 10, maybe even build a whole portfolio to retire so you don't have to work. So what's the main goal for the first investment? It is about buying the trajectory and buying something that can just slingshot it up, right? It's not about buying the best house. It's not about buying security or stability. And this is where people often get mistaken. They purchase it and then they go, oh, I got to wait 5, 10 years to buy the next house. It shouldn't be like that. They should be purchasing every 1 year, at the most every 3 years, but you should be constantly turning over these houses. So first investment is the setup, regardless of whether it is a good house or not. It is to set the scene for the rest of your portfolio. So strategic first purchases, we want to build equity, cash flow, and we want to make sure that the borrowing capacity stays under control so we can keep buying and buying these houses. Now, rule of thumbs. When you're evaluating the first property, ask these 4 things, and these are non-negotiables. Is it easy to rent? Now, to find if it's easy to rent, you need to find out if it's a strong tenant demand with low vacancy rates. These can be found on rewa.com. You can go on rewa.com, and we can grab, let's do it right now, go on suburb profiles. There is a million other ways that you can do this, but rewa.com is just very, very visually easy for a lot of people to see. And we can go down to here and we can go rentals, and we'd see 15 days on the market. That's not too bad. It's a little on the higher end, but we are on Perth, like the actual suburb Perth, where there's a lot of units. So it does make sense, and there's a very limited supply of this, so the data will be a little skewed. And that's probably one of the easiest ways that you can find your tenancy stuff in there. You also need to make sure that the holding costs are fine. So if you're buying a unit, the mortgage might be really cheap, but maybe your strata fees are $1,000 per quarter, which then dips into your profit. So we need to make sure the interest rates, your mortgage, body corporate fees, maintenance, if it's on a farmland, how much is it going to cost to actually maintain it and keep it pretty enough to actually sell it in the future, right? Do we need a ride-on lawnmower or maybe someone that rides a lawnmower for, once a week? It costs $300, which is not ideal, not for your first investment. You need to make sure it's a proven location. Is the location suburbs with infrastructure, amenities, and a track record? The farm example, for example, probably not a good location. There's certain farmlands which, by reputation, do well, but there's no infrastructure, there's no amenities. Why would people want to move from 10 minutes, something that takes them 10 minutes to get to work, to something that then takes them an hour to get to work? And also, number 4, one of the most important, is there room to buy again? So is there enough equity and borrowing capacity to expand your portfolio within 3 to 5 years? Ideally, every 1 to 2 years if you work full-time. If you do it right, it should be 1 every year, possibly 1 every 6 months as it starts going up that curve. So make sure that you choose the price range that checks those 4 boxes. Identify the 3 categories that we have in here of what fits you best. If you're a first investor, usually you want to go around these 2 here, ideally not the last one. And hopefully this will help you make a decision to actually make the property investment, your first one, very, very easy, very smooth. And you can look at houses and the prices and say, yep, this is what I want, this fits that, and my whole lifestyle counts for this. So if you enjoyed that, I have other videos that goes through many investment strategies. Like and follow the channel, and I will see you in the next video.